Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show.
Hey, Jim.
Equity markets, you were saying, around the globe have hit record highs. Does that mean we're in for a record collapse?
Well, I've been saying we were in for a record collapse for about 8 years now. So, yeah, I think we are. I don't know when, though. Basically, what's happened lately is the world's central banks have been, some more, some less, but in the aggregate quite a bit, increasing their at least jawboning about easing. Some of them are actually easing. Like the European Central Bank is still doing pretty aggressive QE. And the Japanese Central Bank also. In the U.S., less so, but they were going to raise interest rates in September, everyone thought, and then we had some fairly weak labor market numbers just come out, and now the odds of a September increase are way down, which means we're at least not tightening. The rest of the world is easing, and so financial asset prices are going up because the markets love easing. If the governments of the world and the central banks of the world are going to create lots of new currency and push interest rates down even further, then some of that money is going to find its way into stocks and bonds. So why not buy the stocks and bonds now in anticipation? And that's what most of the world is doing. This past week or so, we saw U.S. stocks go up pretty dramatically and gold and silver go up pretty dramatically, which means money is just basically flowing into stuff now. If the governments are going to create a lot, it's got to go somewhere, and it's kind of going indiscriminately now into most financial and some non-financial assets, although real estate seems to be left out of this for various reasons. It sounds like especially the Vancouver real estate market is kind of backing off a bit. Jim, you'd know more about that than me, but I've seen some headlines. And it looks like in the U.S. the trophy property markets have topped and are now rolling over. Manhattan real estate is down. Miami real estate is getting whacked. San Francisco is not nearly as strong as it used to be. And so that's probably one more data point that argues against the Fed being able to justify a big interest rate increase anytime soon.
Why have there been so many confusing signals about the Fed's intentions with interest rates?
Well, because the Fed is torn between two imperatives. On the one hand, it's owned by the big banks, like Goldman Sachs and JP Morgan Chase, and they want interest rates to go up because rates in the U.S. are low enough to start hurting their bottom lines. They can't make as much money in this kind of an interest rate environment, so they want rates to go back up so they can widen their loan spreads. And since they're the boss of the Fed obviously wants to accommodate the people that the Fed governors would love to go work for when their terms at the Fed are done and make the real money in their careers. So that's one thing. The other side of the story is that raising interest rates in a world this highly leveraged is incredibly dangerous. You could blow up the financial system with just a small increase in interest rates, possibly. They don't know that for sure, but they're aware that it's possible. So they're dithering now. They want to raise rates, but then the economy is just not quite strong enough to make it, obviously necessary to raise interest rates. So they're holding off, and I don't know. It looks like right now it's less than 50-50 that they're going to raise rates in September. So there's a decent chance that they never get to raise interest rates because the U.S. economy is the only one that's growing creditably anywhere in the world, really, if you don't count China because you can't believe their numbers. And we're not even growing as fast as it looks like we're going to. All our headline numbers are favorable. All the under the surface numbers are scary, dangerous, and negative. So the Fed is caught between these two goals. One is to serve their masters in the big banks. The other is to keep the economy from blowing up and having them be blamed for it. So they're going to wait until they absolutely can't justify not raising rates before they raise rates. So there's no way to know when that's really going to be.
Well, the Canadian bank CIBC is now predicting that Canada's growth rate next year will be 1.8%. Earlier in the year, they were saying 2.1. Is this going to be a familiar story going into the new year? I
think it is. Most of the world just isn't growing. And the reason for that is nothing mystical magical. It's that if you borrow too much money, it gets hard to grow because so much of what you are making has to go to debt service. And so many people who in the past might have been counted on to borrow and spend are maxed out. They can't borrow anymore, and that's the way it is with consumers around the world, and obviously with governments who already are carrying more debt than basically any government in the history of the human race has carried before. If you look at Japan, China, the U.S., I'm not sure what Canada's balance sheet looks like. I assume it's probably better than the U.S., but still not great. And, most of Europe is grossly over-leveraged, and they're continuing to borrow, but they're not getting any more bang for that borrowed buck, which means they're just digging themselves more and more deeply into a hole. So hence the global financial crisis looming out there on the horizon somewhere, because when you hit the point where you can't grow without borrowing really aggressively, but borrowing really aggressively doesn't produce any growth anyhow, what do? These guys are just going to keep on borrowing, but at some point, even a global financial system as huge as the current one hits a wall in which it just can't borrow anymore, and the debt that it's already taken on is causing more trouble than it's solving, and then you enter a death spiral in which there's no fix. Everybody will try to devalue their currencies, but that's a zero-sum game against one currency against another, and so when that happens, the confidence of the traders and investors and savers of the world will evaporate. We won't trust our currencies anymore, and we won't trust our governments to make it right anymore. And when that happens, everything blows up. So we're headed for that. There's no way to know when it's coming, but and again, I would have said it would have come before this. But we're clearly heading in that direction. All trends point towards ever-increasing leverage until the system just implodes. And I think it could come sooner rather than later at this point, because with interest rates below zero in most of the world, government debt already at record levels, consumer debt already at record levels, it's not clear what we do from here on out to generate anything other than more leverage and a greater propensity for a collapse.
Is that why gold and silver are expected to increase in value in the short term, even if we have a correction?
Well, in the short term, there's no way to know what anything is going to do. Markets are inherently unpredictable, and anybody who tells you they know what's going to happen in the next 3 or 4 months is really just making it up in order to, fill some empty time. But over a longer period of time, these are the kinds of conditions, excessive leverage, aggressive money creation, slow growth, et cetera, that tend to lead capital out of financial assets and into real assets like gold and silver. So if history is any guide, the situation that we've put ourselves in will lead to a panic out of bonds and most equities and into precious metals and other real assets like well-chosen energy assets and very good pieces of real estate, stuff like that. So that we'll see a kind of a changing of the guard where the financialization of society will be lessened and capital will flow into real assets, which will then become the very valuable, important things to own.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. John, some people have suggested because there's so little natural growth, the only way a company can make money is to acquire or merge with somebody else. Bayer now upping their bid for Monsanto to $65 billion. Is that what we're going to see right now?
Well, this is what happens at the end of cycles. You know, companies find it easy to borrow because interest rates are low, but they don't have any really good ideas for investing that money because they, they're seeing their businesses plateau and to an extent roll over. So they're not comfortable building a new factory, for instance. So what they do is they borrow the money because it's so cheap, but then they buy back their own stock. Or they try to buy out a competitor to build an empire. Because, if you're the CEO of a big company, one thing that always sounds good is buying your next biggest competitor and creating an empire, and that's a turn on to these guys whose egos have driven them to work 16-hour days for 40 years to finally get to the top of these companies. Why not create the very biggest thing that's ever been seen in their industry and that way be treated like a king by everybody else that they hang around with? So you see these guys paying exorbitant prices to buy out competitors, and most of these deals in the ensuing recession, because this is kind of how you know a recession is coming, because this stuff is happening. In the ensuing recession, the deals look idiotic. You could have bought something like Monsanto. Say 3 years from now, you'll be able to buy Monsanto for 1/3 the price that they're trying to buy it for now. Okay, and that's just how recessions work. The values of companies go down, and the guys who bought at the very top look like idiots. But right now, it doesn't feel to them like they're behaving like idiots. They're building empires. They're building a legacy that will be remembered for 50 years. And so this is the kind of thing you see. So you combine easy money with massive ego, and you get the M&A market at the top of cycles.
Yes, we talked about real estate in Vancouver, of course, has been falling in price for a few months now, even before the government brought in a 15% foreign buyer tax on houses in the greater Vancouver area. Is this a trend we're going to see around the world, declining real estate?
In the trophy property markets, prices have gotten so high that, for them to go up from here would be really decoupling from any kind of underlying value. So you would expect over time the most expensive real estate markets today to behave least well. And it doesn't mean they're going to crash, although they did crash in 2008, 2009, and we could easily see something like that again in the near term. But it does mean that they probably won't rack up the massive gains that they've racked up in the past. So I wouldn't buy a Manhattan penthouse or a London brownstone today. and probably the same thing with Vancouver. You've had so much foreign money pouring in over the last few years that unless you assume that every Chinese multimillionaire is going to buy a Vancouver condo in the next few years, there's not a lot propping up the market at today's prices. So in a global financial crisis, which is coming, high-end real estate is going to tank, or already highly leveraged bubble market real estate is going to tank. There will be quality properties that hold their value, but they would be properties that haven't already been bid up and are in relatively stable rather than highly cyclical places like Manhattan and San Francisco, and to a lesser extent Vancouver, are fairly cyclical markets. They have booms and busts. So if you're in the middle of a boom, that's not the best time to be buying real estate because a bust is coming. And contrast that with, say, a college town, where you've got the college and you've got the local hospital and you've got a few local businesses that are the main employers. And let's say you're surrounded by farms, which are also major employers. Your economy is going to be much more stable. It's not going to boom, so your real estate prices probably aren't through the roof right now, but it's also not going to bust. So if you get a good rental property in a town like that, and you'll probably generate decent cash flow going forward, which will be better than what 90% of the people in the world are getting on their investments, so you'll look very smart. So that's the kind of thing to look at this point in the cycle. Cash, precious metals, and really, really well-chosen, cheap hard assets like farmland and rental properties, and to an extent, oil and gas properties.
One of the people I just talked to said the middle class as we know it is going to shrink. Our value of life is going to be less than it has been up until now. Is that a grim, accurate prediction?
Absolutely. When you borrow too much money, that's just what happens. You have to go through a process of getting rid of that debt somehow. And in order to get rid of debt, you have to live smaller than you did before, right? Because you've got to pay off the interest and the principal, or you've got to default on the debt, in which case nobody's going to lend you any more money, so you've got to live within your means. Either way, most people in most developed countries are going to be worse off a decade from now than they are today, at least in terms of living standards. They're going to have less stuff, less freedom, and probably a great deal more stress. And that's just what you get when you borrow too much money. So, the personal advice that flows from that is to pay off your debts, get out of debt as soon as possible, and live small now in anticipation of the crisis that's coming in order to not have to scale back when the time comes, and very few people do that, because once they get into debt at a certain lifestyle level, they don't want to pull the kids out of private school, they don't want to drive a used old car or live in a smaller house. But I'll tell you what, Jim, if most middle-class Americans in their 3,000 square foot houses with their SUVs and their big screen TVs and their kids in private schools, if they really knew what was coming, they would be living in a one-bedroom apartment, driving a 10-year-old car, and using every spare penny to pay off debt. That would be the logical approach to what's coming. But very few people are going to do that, because it doesn't make any sense to behave that way until you're forced to behave that way. And so most people will have to be forced.
Well, of course, with the baby boomers all reaching retirement age, they're going to be doing that naturally, aren't they?
No. Baby boomers expect, by and large, to live well off of the nice pension plans that they've got and Social Security and their appreciated houses and everything. So I think, retiring boomers today and the previous generation, I play poker with a bunch of retired college profs who are living great lives now because they had those phenomenal public sector pensions that they fed for their whole working careers and that they can live off of. Well, the next generation of retirees isn't going to have anything like that. So, millennials and younger boomers are really going to suffer because most pensions are being scaled back. Social Security is going bankrupt shortly. Health care is getting more and more expensive. So life is going to get much harder for future retirees in the same way as it is for today's workers and tomorrow's workers. Life is just going to get harder because there's not enough money to go around when you lose the ability to borrow, which governments and companies and individuals are about to find out.
Do you see a lot of social unrest because of that?
Incredibly. Yeah. Oh, yeah. It's going to be crazy. Because as Gerald Celente likes to say, when you have nothing left to lose, you lose it. And so we'll see a lot of people who, are thrown out of work or see their incomes dropping or are fed up with the local crime because the government doesn't have enough money to pay the cops, like is happening in Chicago now, or whatever. They're going to be frustrated, and they're not going to take it quietly. They're going to vote for people like Donald Trump, first of all, which is already happening in the U.S., and Marine Le Pen in France, and then Brexit in Great Britain. And then when that doesn't help, because it won't help until we get rid of this debt, they will take to the streets in a lot of parts of the world. So it's going to be very crazy. And Jim, I have to hop now.
Yes, I was just going to say, John, thank you so much for chatting with us.
Sure, my pleasure. Good talking to you.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.